Welcome to the Grow Your Business and Grow Your Wealth podcast with Gary Heldt. Gary is an expert in helping business owners put together a plan that will provide a better future for their businesses, themselves, and their families. On the podcast, Gary interviews other professionals who share his vision, and together they share secrets and strategies any business owner can use to build a better financial foundation for your business and your life.
Hey, welcome back to the podcast. This week, my guest is Tom Dillon, and he is the owner and founder of Frak Finance, where he helps small to medium-sized businesses navigate, grow through acquisitions, exits, and clear, actionable financial strategies. Welcome, Tom.
Thanks for having me. Happy to be here.
Sure. So, what inspired you to start Frak Finance?
Oh, boy. If I really had to dig deep into it, I would, going back maybe even to and there's a whole transition story of kind of how I got there in my career. But if I really dug deep into maybe the heart of the matter, I think it had something to do with my dad and him looking to sell, his business to practice. But I guess going back as a little way of intro by way of background, I started my career at William Blair, the investment banking firm here. And I kind of parsed my career into three kind of phases, I guess, in this early part of my career, which is the first one being a pontificator. I really was just, basically judging people's questions. If I had to think about it as a kind of, in real estate, I was really kind of just going on an architecture tour and pointing out which ones I liked. Oh, that looks nice. That's a good business. So they do a good job. That's beautiful. And then as I transitioned, I joined a private equity company as their CFO. And that's really where I'd say I kind of became more of a builder, an operator, I should say. And where you're kind of, if you think about it in the context of real estate too, it's people who kind of do maybe gut rehabs and they're putting lipstick on the pig, making it look nicer, getting some value, extracting some value out of an asset. And now I'm kind of in this next phase of my career, which is really this entrepreneurial phase where I'm building and architecting. So I'm kind of sitting in the architecture tour from Chicago. And so someone was talking about this yesterday. And so that's what came to mind. But basically, sitting in an architecture tour, looking at beautiful buildings and kind of talking about what worked, what didn't work, and then moving into actually kind of operating those businesses. How can you extract value, make them more valuable, to then actually looking down like a lot of the listeners here who have built companies from the ground up and said, hey, this is my vision and I want to see it come to life. And so I think there's probably some level of sickness in me about being an entrepreneur and wanting to be that architect and build something. I think it's significantly easier to buy if you do it right. But for whatever reason, I might have seen that Apple commercial with the sledgehammer getting swung up to the TV too early on in my childhood, which influenced me to be the person that I am today. But I think if I really had to get to the heart of the matter, that's kind of the journey that I've taken. And along those phases of my career, I just have found that building and kind of architecting really challenges me and ultimately has led me to where I am today. But I know, at least for me, it's been the hardest in terms of actually building a company and making that vision come to life. And when I go back to the point about my dad and his practice, I remember him talking about, and asking him, like, what was the transition plan? Because none of your sons went to become doctors to take over the practice. Right. Similar to your last guest, Adam, who I thought was very well spoken and really enjoyed his topics. Similar to him in terms of not wanting to go maybe down that path or being kind of advised to not go down that path. And ultimately, it was, I don't think I can sell this asset. And I'm like, what do you mean you can't sell your practice? You have cash flow coming in. You have patients who need care, and who better to transition that care and put a stamp of approval on it for them than you pointing your successor. And so it was interesting that it's not the reality that you can't sell the practice, but the perceived idea, this notion that you can't do it. And I think there's a lot of business owners out there who have built their entire business with this idea that eventually it's going to just kind of dissolve and be shut down. And so I think in my hearts of heart, I think that's probably where a lot of kind of this desire and passion to help these small business owners in this corporate advisory fashion. And Frak Finance, we're really a boutique corporate finance advisory where we do fractional CFO work is kind of what we're most known for. And so that's a long-winded answer to your
fine.
question, but I figured I'd kind of give some context as I reflected on my own career, I guess.
Right. Now, you just mentioned that you guys provide fractional CFO services. We're hearing that a lot more now than we have in past years. Can you explain to our listeners what that is and what it means to be a fractional CFO?
Yeah, so we service the SMB community, the
All right,
small, medium-sized.
hang on. So we don't do acronyms.
I was just about
because not everybody knows what all the acronyms are.
So those are the small, medium-sized business owners, and we serve that community. And most of these business owners can't afford a full-time CFO, or at least a full-time CFO with the experience and that they bring the value that's required for their operations. Mm-hmm. And so fractional CFOs, it's really just a new term for part-time or consultant, but they're brought in to really supplement the team and feel like they're a part of the team, but you don't necessarily need a full-time one to get the value. They get you 80% of the way there. And so that's what fractional CFOs are.
Compare that to the outside CPA that's doing tax returns for them.
Great question, Gary. So, and it's really interesting you bring this up because the CPA tax return is you're getting the books dropped on their desk at the end of the year from your bookkeeper. And ultimately, they're looking to help you reduce your tax liability. And they're going to file your taxes. And then you have your wealth advisor who's, helping you try to protect your wealth and also limit taxes with different strategies. And then you have your CFO who's maybe part of your fractional CFO who's part of your internal operations. So you have these three individuals that are all advisors to this business owner that rarely ever talk. And I find that to be problematic.
Yep.
And so that's why I really appreciate what you do, Gary, and you're bringing these conversations to life around the wealth management, the tax aspect, as well as the operations. So I'm more of an operator. We don't deal with people's wealth. We don't deal with taxes. We'll help implement the operation side of tax strategies. But ultimately, we're there to help grow your business. And I think there's two types of fractional CFOs or just CFOs in general that are out there. You have your cost-cutting CFOs that give that everyone doesn't like the CFO and gives them a bad rap. Right. And then you have your growth CFOs. We're growth CFOs. We can certainly do the cost-cutting and plug the holes where we see fit, but that's something that's done once. You can't cost-cut your way to profitability forever, not if you're looking to grow. And so what we really do is put in place game plans for both organic and inorganic growth. And what I mean by that is growth through acquisition. So mergers and acquisitions of buying either competitors or other verticals or service offerings to grow your company, or do it organically by working and game planning with your sales and marketing team.
Great. I know that, lots of times I run into business owners that think that the CPA is supposed to be that fractional CFO that's supposed to tell them, hey, this is how you should be marketing. Hey, this is your bookkeeping. Hey, this is your tax planning. This is your retirement. And that's really not going to be one person. and in my opinion, shouldn't be one person because everybody kind of has their expertise. And to me, a CPA accountant is just like a doctor. They all have their specialties in what they do. And it's important to make sure, and I constantly preach, you build your professional team and you let them talk, just like you're saying. And when you don't, you're really doing yourself a disservice by not letting them talk, because I may be the tax planning CPA and I am looking at something one way. You're in as the fractional CFO who's trying to grow the business. Well, you and I need to talk, because if you're growing, I need other tax strategies that I'm going to use to help reduce the tax liability. And then we also need to talk to the bookkeeping side also. So um, I think it's important to have that clear distinction in what everybody's roles are, but make sure that everybody's talking. What in what you've been doing as the fractional CFO, what do you think is the biggest misconception of a fractional CFO?
I think the biggest misconception is that they are part of the bookkeeping. They are part of the team, but they're the bookkeeper, the controller. So
Right.
more of the accounting aspects rather than the finance aspects. The accounting aspects in someone's business are going to be, what does that monthly close look like? And tactically, how can I close the books quicker so that I can get a view of what happened? So the accounting team is the rear view mirror. If you're thinking about a car, I'm like jumping on these analogies today, and some of them are hitting, some of them are not. But this one I think is good. The car that you're in is you're looking in the rear view. That's the accounting side, your bookkeeping, your controller, the one who's setting your chart of accounts of how your financials come out and then making sure that they're closed quickly every month. The CFO, they're looking out the windshield and where we're going. And so when you think about your team, that's really the difference. And that's an analogy that I think can help a lot of business owners understand the difference between your controller and your bookkeeper versus your CFO. One's thinking strategic and growth of where are we going? And they should have a strong team supporting them to say, where have we been?
Yeah, I always look at it, I always tell people the typical CPA bookkeeper is a historian. They're taking information from the past, putting on the forms, and then they're doing that compliance work where you, as the fractional CFO, like you said, you're looking forward, you're trying to grow, you're looking what's coming at us and reacting to it before it even gets to, that controller type person.
That's right.
You talked about you help people with acquiring businesses and growing their business. What are some of the common mistakes that you're seeing people make that don't have someone like you in their camp helping them with this type thing?
So they don't start soon enough in terms of planning. You've heard that before. You're going to hear it again. I think in terms of I guess I'll give a story with regards to a client that will help lead us to a little bit of advice in what I think you should do as a business owner. So we had a business owner who hadn't made any plans. We came in where they were struggling. It was a little bit of a turnaround story. Hey, we've got some cash flow coming in. We're slightly profitable, but we're just not getting over the hump to really feel like this is a transferable asset someone would want. That was a huge mistake. That was a misnomer there. They didn't view and understand that someone would buy their book of business and layer it on top of their already existing overhead. And overhead meaning your management team and the people that on your team that are servicing those clients, those could have been bought. So this individual really ultimately didn't have a plan. Things came to fruition pretty quickly with losing one of their biggest customers, where now they were no longer profitable. I don't know if someone got wind or whatever, but someone made a decision to leave. Ultimately, what happened was the business is now losing money. The business owner really doesn't want to go through taking on debt to try to service this, or infuse the company with their own cash. So now it's in the process of, do I sell? Can I sell? Or do I just wind this down? And unfortunately, like so many business owners, they don't realize the value that they have. And then ego gets in the way of trying to figure out what this is going to look like as I transition it. And now I have to stay on for 6 months and help transition it, or longer. I don't want to do that. I can't imagine not holding the reins. And so it's not that they couldn't do it, it's that they just didn't plan. And so for this individual, the business, they ended up dissolving the company and winding everything down because the business owner made the decision that it wasn't worth their time. And we were talking about probably $400,000 on the table that they didn't realize could have been in their pocket, on top of a consulting fee monthly that they would have been paid out during the transition period. And most importantly, keeping the team intact and employed, which is what my goal was. And for whatever reason, the plan wasn't in place. It felt like it was being kind of forced upon them by this potential acquirer, and they didn't like it, and they didn't like their personality, and they felt like there wasn't another option. And so they decided to dissolve the company in terms of preserving their legacy. To me, that doesn't make sense and doesn't resonate with, I think, how most business owners want to actually transition their business and kind of keep their team intact. So it was this emotionally charged time period in this person's life. I had the opportunity to talk to them about 6 months or so, maybe a little longer after. And they said it was a huge regret. He said, Tom, I know you came in there and you were only there for a few months before we were able to really take an opportunity with this business, and losing that client just turned everything, into a pardon my French, but a shitstorm was their language. And it was unfortunate because people were freaking out. One of the key employees decided to leave as well. And so it just wasn't a good time, and it wasn't fun for anyone. And I felt terrible for them. And I think this was the same kind of getting back to what kind of drives me and the passion of why do this. You could go work for a big company, be a CFO. Why the small and medium-sized businesses? And I think it's because there's such a need, and there's such a profound impact you can have on people. And if there's two types of, I guess, that things that are the most important, which is, I think, your health, obviously, which is your physical health, but then the second is the financial health. And so from this standpoint, I never took over the medical side and the physical health aspect, but I have an ability to really make a profound impact on people from the financial health. And so that's really what drives a lot of the decisions that I make in my career, my life, is how big of an impact can I have on people? And the impact that you get to feel and the wins you get to celebrate with so many different teams, and be able to help them pay their team more or pay out bigger owner distributions is an incredible feeling. And so for us, circling back to your true M&A question, you really have to plan accordingly. I would say 5 years if you're looking to take advantage of the small business tax benefits, but certainly sooner than later. And you really want to ensure that you talk to someone like me, or someone that understands business valuations, for the puts and takes of what levers can be pulled in order to increase the enterprise value, the organization, your business's value that someone's going to pay you for. And there's just so many different levers that most business owners have no idea. I think the biggest one, and I know that people have said this before on your show, but it needs to be said constantly to remind people, for anyone that are new, the less the business owner is involved in the business, the more valuable the business is. Let that resonate. The less you're involved, the higher the price. To most people, they just can't reconcile the two.
Yeah, I think that, you touched on a whole bunch of points in there that I think are important. One is saying, hey, it's like, hey, about 5 years out from when you think you're ready to sell, you really need to start talking with someone. So they can help you set the business up to be sellable at a higher multiple, but then also putting yourself in the right place, right space for letting it go. So many people, our businesses are our babies, and if they're ugly or if they're pretty, either way, I think you have the extreme where you have the one side that thinks that their business is worth a hell of a lot more than it is. Then you got the other side that thinks it's not worth anything or it's not sellable. But they need to talk to somebody who's gone through this multiple times. And I will tell you, the typical CPA has not gone through it. So you need to look someplace else besides to your CPA, because many times that CPA has never gone through a sale of a business. And if they have, it's on the very back end and they're trying to put it on a tax return. So that's something that's really important. But then also, just like you said, that the less the owner is involved, the more the business is worth. Because many times the business owner truly owns a job, not a business. And you got to get it to where you own a business and not a job. And we've talked about that numerous times on the show also. So I think that that last 5 minutes there was very, very, if you guys haven't listened to anything, go back, listen to that again, because that's extremely important to do that, but then also making sure that you have your team of professionals to get involved if you want to, you're thinking about selling your business. You definitely want to do that. Tom, there's a lot of good stuff here. What have I not asked you wish I had?
I would say, are all CFOs created equal? And the answer is no. Just to Gary's point about how a lot of CPAs haven't gone through an M&A transaction, most CFOs have never gone through an M&A transaction. And so if you're in the position of looking to grow inorganically, meaning growth through acquisition, or you're looking to position your company for an eventual exit and sell it, just make sure that you have a fractional CFO or a CFO that has gone through this process. There's, two real big phases that you'll be involved in. There's 3 total, but the due diligence phase, which is someone digging into your business, the financials, the operations. Do you have SOPs in place? Do you have financials in place? And then the second phase is the transition and execution of the new owner taking over. And so you really want to understand what that process looks like to help you really plan accordingly, because it's going to make your life so much more enjoyable during that time period, as well as post transition in retirement, that much more enjoyable.
Appreciate that. Tom, if people like what they hear and they want to reach out to you, learn more from you, or even engage you in service, how can they reach you?
LinkedIn is a great one. Tom Dillon, CFA, or our website is www.frakfinance.com. And you can always reach me via email as well with tom@frak, F-R-A-K, finance.com.
Great. Tom, really appreciate your time today. And I think our listeners got a lot out of today.
Thank you, Gary. Appreciate being here.
Great. Hey, this week my guest was Tom Dillon, who is the owner and founder of Frak Finance, and I'll see you guys next week.